Welcome to the DPA Advantage program. Let's jump right in. The DPA Advantage program offers a wide variety of eligible borrowers with down payment assistance in the form of a grant equal to 2% or 3.5%. I have not been this excited about a down payment program, assistance program, in probably ever. But I am super excited about this program, and one of the reasons is because of this. There is no repayment required. That means there's no loan, no lien on the home. It is literally a grant, as I stated before. So that is the most important part of this program and what makes it a game changer. Most down payment assistance comes in the form of a loan, whether that loan be repayable or it's forgiven, but you have to stay in the home for a certain amount of time or you cannot refinance. The biggest thing about this program is that it's a grant. So it does not have a repayment required, and there's no second loan, and there's no lien on the home. Now, a home buyer education course is required, and you do have to take that up front before receiving the grant. But you can also get seller concessions of up to 6% of the purchase price. So that means whatever the home price is for your borrower, you can negotiate up to 6% for the seller to pay the closing costs. That means they get a grant for their down payment, and then the seller can pay their closing costs, so they're coming out of pocket very little money. Obviously, they're going to need money for things like credit checks, earnest money, appraisals, and inspections. But as far as having to come up with a large down payment, they do not have to do that. Now, as I stated before, because there's no repayment required, there's also no resale or borrower repayment restrictions. That means if they sell their home, like most down payment assistance loans, they have to pay it back if it's within a certain amount of time, or they have to pay monthly on the assistance. There is no resale or repayment restrictions. The grant is forgiven the day they close. So once they close, that grant is totally forgiven. So it really works just like, say, a person is purchasing a home and their mom says, hey, when you buy your first home, I want to give you a 3.5% gift. I want to give you gift funds for purchasing your home. The borrower has to sign a gift letter. The person giving the money has to sign the gift letter and say, hey, I'm gifting them their down payment. They don't have to repay me or anything. It's no repayment expected. I'm just gifting them those funds. This is the same thing that happens, but in this case, the lender is the one gifting them a grant. It does not have to be repaid, and they don't care if they sell the home or refinance it for that matter. Um, the minimum FICO score required is a 620. So they do have to have at least a 620 credit score, and we do only take the FICO score for this. But another good thing is manual underwriting is allowed. So that allows people sometimes who would not otherwise qualify to be able to qualify, because there's a different set of guidelines that they have to meet. But if they meet those guidelines, they can still purchase a home even if it has to be manually underwritten. So the biggest thing that I want people to take away today, because I have had so many calls and so many messages about like, what's so special about it? What's going on? I need more information. This is what I want people to take away from this. It follows FHA guidelines. That means there's no special restriction on debt to income. If they were to apply for an FHA loan, they would it would be the same guidelines. They are literally, your borrowers are applying for an FHA loan, but instead of them having to pay the 3.5% down payment that they would normally have to pay for with the FHA loan, they're going to receive a grant. That's literally the only difference, outside of the fact that they do have to have a 620 instead of the normal 580 with a FHA loan. But there really no other big things besides the 620 score and them having to do the home buyer education course. Outside of that, your borrower is literally applying for an FHA guideline, a FHA loan. It follows the FHA guidelines. That means they can purchase anywhere. It's not like a USDA loan where it's in certain areas. It means there's not a special debt to income. If they would qualify for a FHA loan and they have that 620 credit score, they qualify for this grant, and it's nothing special that they have to do. Whatever their approval would be with FHA, that's what they would be applying for with this grant. They're just not going to have to put down a down payment. I cannot stress that enough, because I have people constantly asking, what are, this, are there any restrictions? Is there a special debt to income? Can you only buy in a certain area? No, there are no restrictions. They are literally applying for an FHA loan, and instead of putting down a down payment, the lender is giving the grant for the down payment. Now, the only other thing is it is not available in New York or Washington. Some program specifications. Again, the grant is with FHA. It requires a 3.5% down payment. So the grant will give you the full 3.5% payment, or there is an option where you can get just a 2% grant. So for those people who have some money, but they may not have the full down payment, you can do the 2%, and both options are available to everybody. There's nothing special that you have to do to qualify for either or. It literally is just, some people might have if you have 1.5% of a down payment, but you don't have the additional 2%, you can opt for just the 2% grant and you are covered. If you don't have enough to pay for any of it, you can opt for the 3.5%. Again, it's a minimum 600 or 620 qualifying credit score. In our underwriting methods, we use, these are to the loan officers. These are some program specifications. They can do a 20, 25, or 30-year term. So for someone who does not want a 30-year loan, we can do this in a 20-year or a 25, or you can do a 30-year and all of the interest rates are fixed. Now, it does have to be for a purchase only, and not only a purchase, it does have to be their primary residence. So this cannot be used to purchase an investment property, and it cannot be used to purchase a second home. Again, the maximum limit on the LTV is still 96.5% because the 3.5% down payment. The debt to income, again, we follow FHA guidelines. Program overlays, there are none. We follow, again, FHA guidelines. So there are no special restrictions on this. It literally is an FHA loan that they just receive a grant for their down payment. Again, the home does have to be their primary residence. However, they don't have to be a first-time home buyer. That's another thing. A lot of people, if you have a home right now, let's say you have a borrower that has a home and they want to sell that home and they want to purchase a new home, or they want to keep that home and rent it out and they want to purchase a new home to live in. As long as they are purchasing their new home as a primary residence, they will actually still be able to qualify. And you can buy up to a 1 or 4 unit residence. So that means multiplex, duplex, triplex, quadplex, single family home, all of those are eligible, as well as manufactured homes, condos, and PUDs, planned unit developments. So now that you've heard all of that, I know a lot of people are like, okay, this is too good to be true. What are the cons? So I would not say there's really any big cons. The only con is someone who qualifies for a traditional FHA loan without this grant are going to likely get a lower interest rate. And this comparison here really breaks down what you're looking at. So here, this is a home purchase of 560. Again, there is no income limits. And there is no limit as far as the home price. It follows FHA guidelines. So the only limits that your borrowers are going to be restricted to are FHA loan limits. But if they can purchase a home with a traditional FHA loan, they can purchase it with this. But this is a home of 560. Putting down 3.5%. The first option is with our grant. The second option is with a traditional loan. So this is a person with a 620 credit score. And what we did is I put someone purchasing a home at 560 with a 620 credit score, and I did a comparison. The first would be the grant. As you can see here, the rate for the grant is a 7.25%. However, the rate for this same person purchasing an FHA loan and bringing their own down payment is a 5.62%. So you can literally look here at the difference in the monthly payments, and the difference in the monthly payment is literally almost $600. That is the difference. That is the difference. Also, the 7.2% rate is going to cost the borrower $3,700. So that's going to be a part of their closing costs. Over here, that same rate of 5.62 is actually going to give this borrower a credit of $65. Now, what this means is they're paying more here in closing costs with the grant because the rate is not only higher, but it costs more. Versus if they're able to put a down payment down, they're getting a lower rate and it's costing less in closing costs. So that to some is a con. However, you are still getting granted this money. So the same person, they are going to pay almost $600 more a month. However, if they are okay with this payment, so if this person applied for a home and didn't have money to put down a down payment, but said, as long as my payment is no more than $4,500 a month, I can comfortably take care of that. This could be someone that is a good candidate because their payment is still less than what they want to pay. Although it could be $600 less over here, they don't have the down payment, and that down payment is going to be almost $20,000. So they don't have $20K up front, so they're going to pay for it monthly by paying more. However, after they make their first 6 months on time payments, because this is a grant and it doesn't have to be repaid, they can look into what's called a streamlined refinance. And that is literally to just lower the interest rate. Now, with the streamlined refinance, what that says is if you've paid $4,400 for 6 months on time, then we know that it's highly likely you can pay $3,800. So we're not going to make you show all your income documents anymore. You may or may not have to show bank statements. That's just whether or not you're going to have to bring funds to close. But a lot of times what people will do is they will refinance towards the end of the month, so that their loan is paid off at the first of the month. And when they would normally be making their payment anyway for the month, they bring that payment to closing. If they do have any closing costs. Now, sometimes you can wrap your closing costs into it, but with the streamlined refinance, they're not going to have to go through all of the things that they have to go through when they're purchasing the home, like, income, W-2, showing all of that stuff, because they've already proved they can handle 4,400. So 38 is not a problem. So that's what a lot of people do. They use the grant to get into the home. They make 6 payments on time. As long as this number is okay with your borrower, that is the goal. Once they make those payments on time, they do a streamlined refinance, come over here and try and get to this, 5.6 or even a 6%, which is going to save them significantly money monthly. And that gets them in the home that they want without a bunch of out-of-pocket money. And then they can go in and do that streamlined refinance. With the streamlined refinance, a lot of times, we can even take a soft credit check. But that is how people are purchasing the home and not having a lot of money. But that is what may to some be considered a con. The rates are going to be higher. I don't make no mistake about that. You're paying 7.25 for a rate versus 5.625. So some people are going to say, oh, that rate is too high. Well, for somebody that can't come up with $20,000 for a down payment but can pay 4,500, they might be paying 4,500 now in rent and have been paying that for a year or two. To that person, this makes sense to them, because now that 4,500 that they've been paying, they're putting it into a mortgage. And again, they can look at refinancing in six, after they make six payments, so in 7 months. So this grant is a total game changer. Again, you want to be able to tell your clients, if they're asking you questions, what I've been telling everybody is literally, this is an FHA loan. You are applying for an FHA loan. You have to have a 620 credit score. And if you are approved, the lender will give you a grant to cover your down payment. That is it in a nutshell. There are no other big caveats. There's no big surprises. There's nothing you really need to explain except you're applying for a FHA loan. You do have to have a 620 credit score instead of the 580. And then if you're approved, they'll give you the 3.5%. One thing I do want to leave you with is, because it's a grant, grants go into the system like gifts. So again, the same thing as if they were getting gift funds from a relative. Sometimes when we put in gift funds into the system, it kicks it out and does not give an approval. In that event, if it doesn't give an approval, it'll give a refer. A refer means a manual underwrite. As long as they meet manual underwriting guidelines, they still can be approved. But just know, when you add a layer of risk, which a grant or a gift is considered, it sometimes may otherwise, if you're using your own money, give you an automated approval, versus when you put that on, your loan has to be manually underwritten. But again, because this program allows manual underwriting, they could still be approved. Any questions?